Hello, welcome back to Max International Tax Talk. Today we will talk about BEAT tax, base erosion anti-abuse tax. So this tax is a minimum tax. The purpose of this tax is to prevent erosion of US tax base. So it functions as alternative minimum tax and effective after taxable year 2017. So it requires taxpayer to compute additional tax after taxpayer finishes regular income tax computation. And minimum tax will ask you whether you take some too many benefit from the tax code. If the answer is yes, then the BEAT tax asks you to add back some deductions and multiply 10% BEAT tax rate. If this amount is higher than your regular income tax, you end up to pay the higher of the two. Do you know why BEAT tax has become more and more relevant in 2022 and 2023 and going forward? It is because there is another provision called Section 174. Starting from January 1st, 2022, Section 174 requires taxpayers to capitalize or qualify R&D expenditures under Section 174 and take amortization over 5 years or 15 years in the case the expenditures can be attributable to a foreign R&D activities. So because of capitalization rule, taxpayer may end up have a higher taxable income and also higher modified taxable income. I will talk about modified taxable income in a moment. Then taxpayer end up to pay additional BEAT tax. So that's why BEAT planning has become more and more important. Today, I will talk about the overview of BEAT, who is qualified as BEAT taxpayer, and how to compute BEAT tax. And next section, I will dive into the detailed rules to explain the potential planning ideas for BEAT taxpayer. So first, who is applicable for BEAT tax? So only corporate taxpayers, not C corporate, not S corporation, not partnership, not individual. Only C corporate taxpayers are qualified taxpayer for BEAT purposes. Another requirement is called annual gross receipts for the past 3 years must be over than 500 million. So the third requirement for BEAT applicable taxpayer is base erosion percentage must be higher than 3%. For some banking industry, the base erosion percentage must be higher than 2%. You have definitely lower threshold. It's easy to meet this threshold and become a BEAT taxpayer. Since I just talked about who is applicable taxpayer, now I'm gonna talk about how to compute your BEAT tax. So as I just mentioned earlier, you need to compute your regular income tax first. You know your regular income, you know your regular income tax. Then you will know how many payment can be identified as BEAT payment. BEAT payment means the C corporation made an outbound payment to its related foreign party for which a deduction is allowed on regular income tax. So you know how many payments are BEAT payment. Then you add back those payments to your regular income tax, and you get to a modified taxable income, which is called MTI. Then once you have MTI, you multiply 10% BEAT tax rate. You get to a BEAT tax. If your BEAT tax is higher than your regular income tax, you end up to pay the higher of two. So you have to pay additional tax for that difference at BEAT tax. So as I just mentioned, 174 will impact your MTI and taxpayer may end up to pay additional tax for BEAT. Next session, I will talk about how to mitigate tax. BEAT tax by some great planning strategies in the market. So I'm looking forward to see you guys in next session, BEAT planning section. Thank you, everyone. Bye.